Hello, good morning, everybody, and welcome to the Daily Energy Markets podcast, where we have it's the middle of November. It's the middle of the fourth quarter at November 14th. And we have Brent crude oil trading up almost 2% today. It's pulled back a little bit through the morning in Asia, and the sort of momentum appears to be the idea that there's a sort of a greater call on demand by IEA into the new year. So a bit of a whiplash in terms of where the IEA have taken the world over the last few days. Let's kick off this morning with David Fife, Chief Economist at Argus Media. Dave, welcome your thoughts just as we wrap up the week here. Oil prices have been on a bit of a whiplash journey, and so has the whole forecasting industry, if you like, led by the IEA Multilateral Agency for the OECD. And Goldman Sachs have rode in behind IEA. Are all these people should be fired rather than getting a chance to put out new forecasts?
Good morning. No, I mean, I think we've
I
essentially,
feel their pain, is that it?
I think what we've essentially seen is that the IEA has reinstated a pre-existing current policy scenario, which essentially says, what does it mean for hydrocarbon demand going forward if environmental policies, energy policies are frozen at where they are today? Now, they jettisoned that forecast after the 2019 WEO. Quite why they jettisoned it, I don't know. I think it's a useful guide rail policy for policymakers to say what happens if policy is frozen. I don't think the IEA has sold it as being their base case scenario by any means.
No,
Uh,
it's true. And in fairness, they've called it a scenario rather than a forecast.
And our view, the Argus Consulting outlook, is much closer aligned to the IEA's stated policy scenario, which tries to see what the thrust of policy is going forward over the next 10, 15 years. And you come up with an oil demand number in 2050 that is somewhere in the 90s million barrel per day. So the idea of plateau rather than continued growth. Interestingly, they seem to have taken some of the numbers away from the net zero scenario, which they still run, which says what is the level of demand that you would need to see to achieve net zero by 2050. And obviously, implicitly, that demand number would be much, much lower than either of the two numbers under the stated policies or current policies scenario.
Let's go across to India to Ram Narayanan, Senior Energy and Commodities executive in India. Ram, to get a perspective from there, because another big part of this week has been obviously the impact of the Russian sanctions and on oil exports coming out of Russia and the buying of that from obviously big buyers like India. It does appear that there might be some bite in these US sanctions and India responding to them built into their trade deal. Can you speak to that from the point of view of where India is at the moment and its outlook for continued buying of massive amounts of discounted Russian oil?
Good morning, Sean. Morning, everybody. Good to be back on this podcast. Well, you raised a very pertinent point, and that is what is running through the entire Indian industry, that India's buying of massively discounted Russian oil. The first point I would like to say is, it was massively discounted when oil was trading at around 80, around 80. But right now, when oil is trading around 63, 64, the discounts are reduced to fuel, very low single-digit numbers, and in many cases, practically zero. So that is the first case that we are looking at. And the second thing is, of course, everybody is aware, the US has imposed a 50% tariff on Indian goods because of buying of Russian oil. And all this has played into India's trade strategy. Well, one other thing that needs to be kept in mind is India also buys a lot of defense equipment from Russia and has got a great relationship with Russia. So therefore, the way it has spawned out is like India's exports has been affected because of the US tariffs. So therefore, the government had to take cognizance of that. And from what we hear is like, your trade deal is very, very close right now. And of course, that statement was made by President Trump, and take it with a pinch of salt till it actually gets done. But the latest things that we see is like a lot of ice has been broken, and probably we're close to a deal. And one of the major points is like to reduce the amount of Russian oil. But also from the trade front, there has been ban on the two of the Russian companies which are supplying oil. So many of the Indian companies, including the private refineries, also have been resorting to buying crude oil from the Middle East. And so therefore, maybe when we see the numbers for November, or probably when we see the numbers for December, I think my guess is we might see a drop in the amount of Russian oil that is going to be imported by India.
But in terms
So
of just the mechanics of it, do you see, or is there reporting in India of actual political pressure? I mean, most of these big importers in India, the big national refineries, are national state-owned entities. Are they being instructed to pull back on the Russian crude?
Yep, they've been sort of nudged softly. Plus, of course, the market dynamics also push them to look at other sources of crude oil. But yes, the point I would like to make is there's been a softness, there's been a slightly nudge from the government to look at other sources. Plus, at the same time, the ban on the Russian oil producers has also sort of forced all these players to look at alternate source of crude. So that's a scenario that's planning out in India. And then, as I said, probably we see the numbers for November or December. My guess is we might see a drop in the amount of Russian oil in India's oil mix.
Let's go to Charles Elinas. Welcome back, Charles. The other story that's making a lot of headways this week as well is the idea that the inflation element that played so badly for Joe Biden a year ago in the US elections has come back to bite Trump in the most recent elections in the United States. And there is now reporting that he is going to be cutting back on tariffs substantially, it would appear, after this trauma of the last 6 or 9 months, and 50 and 100%, which are biggest neighbors, Canada and Mexico and the rest of the world and so on. It now appears, particularly on the food front, a real big hit on inflation into the sort of consumer end in the US, the back away from that. Your thoughts on that as the next part of this traumatic era of Trump, and what that might likely mean for economies and the energy markets?
Well, there is definitely a retrenchment in what Trump is doing. The fact, though, is that a lot of the tariffs have already been negotiated out, so it's not a big problem anymore. Even the American economy, the global response to tariffs has been one of well, it's there. We are dealing with it. It's not a huge problem. So all of these developments in the United States are.
It's obviously a huge problem because the people who are voting are saying it's a big problem in their lives.
Yes, within the United States, it's a big problem. Yes, the impact on food prices, as you say, going up as a result of tariffs, is a big problem. But Trump has already been retrenching on tariffs. It's no longer big news. And I expect that after the elections, he will realign American politics away from huge tariffs and encourage prices to come down within the United States.
David, looking at that point, obviously, the macro picture in the US and elsewhere, I mean, we talk about the foggy predictions on oil demand and outlook, but also on where the macroeconomic journey is, particularly in the US and China. I mean, China, we've lived with a year that China's macroeconomic outlook has been somewhat flat to negative in terms of their relative performance, but yet oil demand, oil buying has remained quite substantial. But the US US has really been the pillar of the global economy and the pillar on the world's largest oil demand, oil consumer. Where is the US economy now? I mean, we have this inflation issue. Now we have some of the Fed delegates saying that don't bet on another rate cut next month. What's your house view on where the US economy is going into the end of the year?
Yeah, I mean, I think our base case for some months now has been that net, the impact on the US of tariffs is likely to be inflationary. And therefore, we didn't buy into this idea that there was going to be 5 or 6 rate cuts ahead all the way through 2026. So we suspect the Fed may have to be a little bit more cautious. Of course, their job is not made any easier by the paucity of data because of the government shutdown. But our underlying view is, and has been for some time, don't expect aggressive cutting of rates by the Fed. We think the dollar is probably finding a floor. Indeed, it's had a bit of strength recently. So we have a slowdown in the US, but we're not predicting anything like a recession. And therefore, the demand stays relatively robust. The big if, I think, is much more around concerns around the US budget deficit. And the second key risk that could kick us off this sort of steady as she goes scenario is obviously if there's some sort of burst in the AI bubble in the equity markets and a renewed flight of capital out of the US. That's not our working case scenario, but some sort of exodus from US assets is a significant tail risk for the US economy through the end of this year and into 2026. We think unlikely to happen, but it's a possibility.
We've seen the market sort of suggest that a few times, where the big sort of 7 technology stocks, which are if I have my data number right, make up 40% of the New York Stock Exchange is the 7 stocks of the technology stocks, who are all somewhat in this very inflated space or real value, fair value space. Obviously, that's for everybody to decide. But ultimately, one of the things, David, that anchors that is the idea that they will all have access to the endless energy demand they need to power their data centers. And that full value expectation is built into the value price of these stocks. Where do you think those two worlds are intersecting going into the new year?
Yeah, I mean, I think you raise a very valid question in terms of over the medium term and energy supply to fuel the construction of data centers. And clearly that's going to be another element that's likely to be supportive of domestic US natural gas prices, because it's very difficult to see the build out of data centers at the levels that are predicted unless you have access to cheap energy. So incremental LNG capacity build out, the build out of new data centers, it's got to be pretty supportive of US domestic natural gas prices going forward.
Ram, looking into where Asian demand might hold up there, obviously the US economy, a big pillar of demand. We also mentioned, where is China going? Because, of course, that has been the big surprise this year that's really sort of blown up everybody's surplus forecast for 2025, that this sort of surplus balloon is just around the corner, and it never came because ultimately China kept buying excess oil for its storage, up to 800,000 barrels a day on some count, and generally 500,000 to 800,000. Nobody really knows because they don't publish those numbers, but ultimately that's where the secondary sources are. A lot of oil put into storage in China propped up the oil price. Your thoughts on the outlook for that going forward as the China economy continues to stumble? We're seeing headlines every day, worst property prices for a year in the latest headlines today.
Yep. I think we saw the numbers today morning. Industrial activity is down, investment is down, consumer spending is down. And you're right in saying that Chinese economy is sort of stumbling. In fact, that's a point which we're debating in Fujairah when we met at Fujairah. Like how much oil is actually China taking in to put up its reserves? 800,000. I'm pretty happy that we have a number right now, which we didn't have about a couple of months back. But at one stage, this amount of oil storage is bound to hit a roadblock. I mean, how much oil can a country save? Then the second point is you look at China's oil demand structure. Let's say the demand's about 16 million barrels per day. And out of the good part, let's say the petrochemical demand is sort of stumbling because the petrochemical markets are pretty weak. From a fuels market, gasoline markets, as well as the diesel markets, have undergone a structural change because of EVs and LNG. Aviation fuel is sort of holding it up to some extent. But if you look at the net demand perspective, and even if you account for the amount of export that China is going to do, so therefore the net demand is bound to take a hit at one particular stage. This year has been propped up by the SPR reserves, which China has built up in a big way. But my guess is coming from next year onwards, I think we might see a sort of a tapering off of China's net oil demand and a tapering off of China's oil purchases also, because of there is bound to be a roadblock. So I think that will certainly affect this oil supply demand balances.
Looking, Charles, to the other big sort of impact on the markets, the ongoing trauma that is the Russian-Ukraine war, which seems to be escalating into the very focused around energy infrastructure, which is again impacting the movement of oil markets this week. And the outlook for that, the potential that there's a full sort of Armageddon focus on energy infrastructure between these warring factions. Your thoughts on where that goes and vis-a-vis where it might even bleed into the west of Europe?
Well, I mean, today's increase in the oil price is partly due to the fact that Ukraine yesterday attacked the port of Novorossiysk on the Black Sea, which is a major oil export port. I mean, this tit for tat is going to continue, and unless I mean, there are some indications that now that Russia might be getting ready to discuss peace, but we've seen that before and nothing has come out of it yet. This is bound to continue, and it's going to affect Europe in a way. On the other hand, I mean, Europe's decision to stop gas LNG imports from Russia by the end of 2027, it's coming at the right time in the sense that there's so much LNG coming into the global market. I mean, the global LNG supplies will more than double by 2030. Compensating for any of these problems in the sense that there is lots of LNG, prices are coming down. Europe is not going to be facing any major energy problems as a result of it.
Well, I mean, we've seen the sort of threats, one would assume, and the reporting indicates these drones that are coming into European airspace, into European airports and other infrastructure, flyby, if you like, drones supposedly coming off Russian vessels in the North Sea and the Baltic Sea, that could translate into being more than just a flyby as this escalation of energy infrastructure gets dragged into the Ukraine-Russian conflict. Where is their outlook for that? What is the sort of discussions around that and Europe's ability to protect against that?
But Europe isn't really responding to that in a big way at the moment. It's just an irritation, and Europe is concentrating on the SAFE program to build up its own defense against that eventuality, against the Russian attacks on Europe. But it's not overreacting to it doesn't seem, I mean, it's news continually. We have news of drones coming and disrupting this and disrupting the other, but there is no massive reaction in Europe as a result of it. I think it's something that Europe sees at the moment, at least, sees as an irritation, and Europe's concern is to make sure that in the longer term it builds up its defense to the point where it can standalone, but I don't think it
Well,
can do.
that will certainly take some time to get to that place.
Right.
You would imagine Russia won't be waiting around for that as Ukraine gets supplied with even more and more powerful weapons to go deeper and deeper into Russia. I think it is a space to keep an eye on into the new year. Let's go to the survey question that's sort of looking at this latest news that Trump is readying substantial tariff cuts designed to address high food prices. His whole political party, the MAGA movement, is under rebellion between Epstein and the price of 6 eggs. It seems Trump is in some hot water with his MAGA faithful, and his Republican Party is telling him he needs to deal with it. What impact will that have on oil prices moving into 2026? We saw in April when we announced the Liberation Day tariffs, oil prices dropped off dramatically. Equity bar, everything dropped off. The global economic trade outlook was very, very bearish. Does the reverse happen? Does that sort of removal of this guillotine above the global economy have the reverse effect of bullish and send prices back up again in the 65 to 70 rather than the 60 to 65? Or indeed, does the current market price reflect that this schizophrenia of Trump is already built into the price and so little impact? Where do you think this goes if indeed we see, because ultimately it could also include the idea that there is a deal with India and Russian oil gets locked in. That means less supply, and that's kind of bullish. So there's a few things to think about there. But David, going into the end of the year now, and we're trading into the new year, and obviously the softer demand window first quarter. Your thoughts as to what do you think starts to sort of bed in as to a more dominant narrative that will sort of break this market out of its tight range, plus or minus $65 on Brent. We've been locked in there for months now. Anything on your crystal ball that says, oh no, we're going to break out from that?
Well, I think there's two sort of countervailing pressures as we go through into the first quarter of next year. One is the question that you've already raised, which is just how effective are tighter US and European sanctions on Russian exporters likely to be. 2 million barrels a day of exported crude from Rosneft and Lukoil are at some sort of risk. That doesn't mean to say they're all going to go off the market, but there's an awful lot of that oil that is currently sitting at sea and not coming ashore. That may be a temporary phenomenon, and Russia may indeed find workarounds. So the net impact may be relatively limited. The other key issue for us remains the fact that we are going to be prone to surplus, I think, running through 2026. So the key issue is OPEC able to stitch together, or OPEC Plus able to stitch together a deal that becomes more proactive once again about removing barrels from the market, because we think there's plenty of non-OPEC supply growth.
Of course, OPEC doesn't see that surplus, right? Their reporting is that it's, the IEA sees a big one, but OPEC are seeing not such a big surplus in 26.
And we're probably somewhere in between the two. We certainly have a surplus. It's not as big as the IEA is projecting, but even OPEC itself has nudged towards a view that there's a risk of a modest surplus in 2026. So that may at the very least mean that they have to extend this freeze on returning barrels to the market beyond March. And we think possibly they may even have to go further than that.
Ram, your thoughts on the same question. Ultimately, the new year, where is Asia? Where is India? I mean, India, been the sort of the engine of big growth for a number of years. Unlike the rest of the big economies, India was enjoying 6 to 8% growth, and sort of saying, the headlines of the next China and all of these things. But with the tariffs face off with the US and other things, where is the Indian economy now going into the new year, and its performance and ultimately its energy demand?
First, the Indian economy is in a sort of sweet spot right now because after the US tariffs were imposed, India had a GST cut, and then it sparked a huge boom in consumer demand. Especially, it was right in the thick of the festive season in India. So if you look at all the consumer spending in terms of cars bought, in terms of consumer goods bought, and all, it's been a boom in India. So from a consumer spending perspective, India is doing pretty well.
And the lower oil price, one would have to say, must be suiting, whether it's discounted Russian oil or whether it's just regular old oil, 60 whatever Brent is pretty good price.
That's right, pretty good price for the government. As you know, in India, the pump prices are controlled by the government, so the government is making money out of it. And of course, they can claim that they have used it to do various other things. So therefore, the consumer spending is pretty strong in India, expected to be so. And from an industrial active perspective, which some of the sectors got hit because of the US tariffs. If the USA tariffs are removed, that is also going to see a bump in activity. And especially when you go into the Q1 of the calendar year, which is always a peak financial year in India. So therefore, from a GDP growth perspective, India is in a pretty strong space, about 6.5 to 7%. And oil demand will continue to be so. But the other aspect which I look into is India is building up huge capacity on the renewable energy, solar space, and to some extent the wind space. So this is also taking away quite a lot of the energy demand from oil, energy demand from the oil, especially when we look at the various data centers that's being built up in India. So, but net is my view was Indian economy growth is going to be around 6.5 to 7%. The further oil demand growth of about an equivalent amount or so. At the same time, because of the booming energy demand, we'll also see a big rise in the mix in the renewable space also. But net is, I think, since China is sort of creping down, I think India's growth is what is going to drive the oil demand growth in the world right now.
Charles, last word to you, because on this question of the impact of these elevated Russian sanctions that are now finally, you would say, at least in this window of time, that, as we know, can change on a heartbeat with the Trump administration. But currently, Washington seems quite serious about these Russian sanctions. And Turkey is a country where we're actually seeing that really have some impact. And we're hearing that India will follow and sort of mirror what Turkey's done, which is ultimately reducing notably its import of Russian discounted energy. Where does that look like from the point of view of Turkey and the East Med, and what is its outlook, do you think?
Well, it's a mixed response actually, because Turkey right now is renegotiating its gas contracts with Gazprom, and rumors are that it will just renew them with no change. So Turkey
does it have an alternative besides LNG? Or I mean,
no, it has LNG, yes, and it has its own production. Its own production from the Black Sea is increasing. It's expected to reach 30% of its own demand for gas. But also the Americans are putting a lot of effort to stop Russian gas coming into Europe in line with Europe's decision to stop all Russian gas and LNG by the end of 2027, both through initiatives in Turkey, but also in Greece. Last week, we had 3 American ministers coming to Athens in a huge conference called PTEC that was attended also by 36 European countries and energy ministers. And all of that was discussion of how to put in place infrastructure to bring LNG, American LNG, into Greece, and from there into Central Europe and up all the way to Ukraine. And at the same time, the US is promoting an initiative in Turkey for beefing up the corridor to bring energy from the Caspian, from the Turcophone countries into Turkey, into Europe. So there is a huge effort by the US to influence the energy flows in both.
Which is kind of the massive political will you need for such infrastructures, a cross-border, like we saw 20 years ago with this, the Baku to Ceyhan pipeline. It takes a massive amount of political muscle as well as the American involvement principally to make these new corridors open.
Yes, it does, and it worked before, and I think it will work now. It will work now.
Does the East Med get into that? Does the East Med participate in that?
The East Med is becoming part of that because this American interest is extended to the East Med through the massive increase in the presence of Chevron and ExxonMobil and the influence of those two big companies on Libya, on Cyprus, on Israel, on Egypt. But one thing we didn't talk about, which may come is coming under the radar, which might affect the situation in Europe, is this joint warning by Qatar and the United States that the new European Corporate Sustainability Due Diligence Directive is seen as a major threat, and they are warning Europe that unless it modifies its climate change rules, they may reduce supply of LNG to Europe. And the reason for that is because the overreach of this directive is massive. If it finds a company violating the directive, it looks at the worldwide operations of the company and applies fines on the worldwide turnover of companies.
Yeah, I was at the speech last week by the Qatar energy minister on that exact point, and I think his quote was that 100% Qatar Energy would stop delivering LNG to Europe if that directive goes ahead. He was quite categoric and firm about it and has been for some time. And as you mentioned, ExxonMobil echoed the same. Obviously, exactly. ExxonMobil, the biggest investor in Qatar LNG as well. We have to leave it there. Brent crude oil trading, what do we have? Little impact. Who cares about these tariff cuts? We cared about them in April. We don't give a toss about them now. That's the reaction in this room. It blew up the market 6 months ago. Now it's irrelevant. Meanwhile, Brent crude oil, as we talked, is trading up 1.5%, nearly $1. It's come off. It was in early Asian trade trading up more substantially. It seems to have tapered back a bit, and maybe as Europe opens and the US opens, it'll end up being a flat day. But it certainly started with some momentum with those headlines, as Charles mentioned, out of Russia and Ukraine war, sort of that endless sort of targeting of energy infrastructure. Thank you so much, as always, Charles Elinas in Europe, David Fife. I'm not sure where the UK is these days. Is that Europe? Is it? But nonetheless, we'll still say Europe. Ram Narayan out there in Asia, in India, which used to be part of Europe, but I don't know, was it? That's another controversial story. Although, what did we see this morning for comic headline relief? Canada wants to join the Eurovision Song Contest. Jesus Christ. Have they nothing else to be getting on with? Wrap it up there. Have a great weekend, everybody. Thank you so much.
Thank you.
Bye now.
Thanks, everybody. Thank you.